Good afternoon, Bruce. Thank you very much for your time this afternoon.
It's my pleasure.
We're going to be talking about the global corporate minimum tax. But before we get into my questions, let me briefly introduce you. Bruce Zagaris is a partner at the DC law firm of Berliner Corcoran Rowe. And in addition to his work around the world on tax and taxation issues, he also is very familiar with these issues as they impact on the Caribbean, which is not necessarily going to be the focus of our conversation today, although um, because many of the countries in the Caribbean are tax havens or have been deemed tax havens, this issue is important to them. So let's get into it. Bruce, recently there has been a lot of information in the media about the global corporate minimum tax. Could you just briefly explain what is the global corporate minimum tax?
Sure. Well, the latest development in the effort to change global corporate tax rules came in June, just a couple of weeks ago in London. It occurred in separate sessions where Treasury Secretary Janet Yellen and then later U.S. President Biden joined with other group of 7 leaders to establish a historical deal to redesign the world tax system. So essentially, the way it would work is that um, in those countries where a multinational corporation did not pay at least whatever the minimum tax that's decided, and it's right now it looks like it's going to be 15%. So if that tax is not paid, then the other countries that have a relationship with that corporation will be able to assess an additional, what's called a makeup tax,
Mm.
so that that corporation pays at least 15% tax. So the next step is to present the deal, this proposal, to a full complement of the G20 countries when they meet in Venice in July. And after that session, the deal goes before 135 countries that have participated from a distance in the talks that the OECD inclusive framework have been organizing. But the deal may encounter some difficulties with several small countries that participate in the inclusive framework.
Okay, let's get into that a little bit. Can we back up a little bit? You said that this is the latest effort to work on to arrive at a global corporate minimum tax. Why is this important? What's behind this effort?
Okay, yes. So several years ago, the OECD started an initiative called BEPS, the Base Erosion Profit Shifting Initiative. So the base erosion profit shifting has the acronym BEPS, BEPS. And the goal is to prevent multinational companies, many of which are high-tech companies in the US, from eroding the base so that they pay, around the world, they pay less than 5%. So in the way that they do that is, let's say their book profits are billions of dollars, but they arrange their structure so that they are based in a lot of low tax countries like Ireland, Bermuda, and then those um, those companies will end up with most of the profit by charging prices for research and for marketing to the parent company. So at the end of the day, on $5 billion, they'll only pay, let's say, 2% tax.
Mm.
And so, so the G7 countries are saying, wait a minute, this is wrong that all these multinational corporations are paying such a small tax, and we have to do something to make for a more equitable tax system so that all the countries in the world are getting, at least a minimum tax, a minimum revenue.
Okay. Okay. So you mentioned that the process is being driven by the G7 countries, or at least the initial deal that's on the table was arrived at by the G7 countries, but there are another 135 countries, or a total of 135 countries, that could ultimately become a part of this agreement. Could you just pick that up from there? What happens next?
Oh, um, so once the G20 in Venice in July endorses the arrangement, they will then send a directive to the OECD inclusive framework, and they'll say, okay, go ahead now and arrange the final details of this arrangement. And then, so then the inclusive framework countries will try to finalize the arrangement. So, and maybe, yeah, so that's the way it'll work.
Mhm. Okay. So you mentioned, so one of my questions was how global is this thing? So that 137 countries, that does sound fairly global. At the same time, there are some of the news reports are that the city of London, for instance, is pushing back, so is Switzerland, and I do know that a number of Caribbean countries are concerned. Are they right to be concerned?
Right. Well, first, the main drivers are really the G7, the G20, and the OECD.
Hmm.
And this move started really historically. It started in 1998 when the OECD came out with a harmful tax practices initiative, and there was so many complaints from the small countries that the OECD changed the name, and then they
When
said,
you say, I'm sorry, when you say small countries, who are you talking about?
okay, small countries include a lot of the small Caribbean countries that have international financial services. That would include Anguilla, Barbados, Bermuda, Cayman, Dominica, St. Lucia, um, Curacao. Um, but it also includes a lot of the non-Caribbean countries. Um, those would be. Oh, and I should have said, of course, the Bahamas, the
Hmm.
British Virgin Islands. But there are a lot of small countries outside of the Caribbean, like Guernsey, Jersey, Isle of Man, Gibraltar, um, Cook Islands, Panama, Mauritius, Monaco, San Marino, um, United Arab Republic, Singapore, even a number of EU countries are really low tax jurisdictions, like the Netherlands, Austria, Ireland, Luxembourg, uh,
Switzerland?
Switzerland, Malta, Cyprus. So they all are have international financial centers, and they have arrangements where they give various tax incentives to attract investment. But
Hmm.
what the OECD did after there were a lot of complaints is they formed what's called an inclusive network. That that's where they got from basically 30 some countries to 137 countries. He said, we'll include all the small countries, but because we're going to control everything, we can use the inclusive framework to basically impose our concepts and our proposals on all of these small countries.
Mm.
And so, that's basically the way it works. And in the OECD framework, and also in the G7, G20 Financial Action Task Force and the World Bank, the large countries that have international financial centers, City of London, the United States, and some of these other large countries, they have enough power so that these initiatives are not going to adversely impact them.
Mm.
So for instance, the Caribbean has lost a lot of its market to Delaware, Nevada, South Dakota, and Wyoming. But those states and the United States as a country never gets penalized because the United States controls the OECD and the Financial Action Task Force, both because the US is the biggest financial contributor to these organizations, and also, just practically speaking, the US seconds a lot of officials to it, and the US has a disproportionate influence on the policies and the decisions of these organizations.
So is it, I have two questions in my mind simultaneously. All right, so address one of the accusations, if you want, that's often levied at Caribbean and other small countries that are establishing themselves or working to establish themselves as international financial centers, concerns around corruption and lax regulations, etc. Could you address that issue? Is that enough of a reason, for
Sure.
instance,
So yeah, there have been,
outflow?
well, yeah, the concerns with respect to taxation are that these countries don't charge a high enough rate.
Okay.
And also, another concern has been that they don't impose enough substance requirements so that in return for a small rate, in return for these tax incentives, they don't make the multinational investors do enough substantial activities in their jurisdiction to deserve such a tax incentive. One other complaint has been that there hasn't been enough transparency, that they haven't exchanged information enough. But this seems to be, by now, the Caribbean has met the requirements to exchange tax information. So the big concern with this, with the latest minimum tax, has to do with the tax rate. And a lot of the smaller countries say, look, it's our sovereign right to charge, to structure our tax system however we want to do it. In fact, in 2001, when the OECD was trying to do this, the Bush administration, Bush 2, complained. And Treasury Secretary at the time, Mr. O'Neill, said it's unfair to demand how countries should arrange their tax systems. That's within the sovereign right of every country, and that the OECD should not interfere with the tax sovereignty of other countries. But now the US has obviously changed its position.
Right.
Now Treasury Secretary Yellen and President Biden say they think a global minimum tax is a good way to go.
Mhm.
So you can see there's shifting the policies of governments shift over time, and so now the U.S. Is supporting the idea of a global minimum tax.
Driven by, so if from the US perspective, how much of this is driven, would you say, or maybe this is speculation, is driven by domestic concerns about the domestic agenda, right? And the need to finance it, and the sort of typical um, power play. We have the power, so let's beat up on these small countries to our
Sure.
advantage. Hmm.
Yeah, the idea of a global minimum tax was really started, um, surprisingly, you might think, in the Trump administration, when in the tax um, in the Trump um, initiative, the tax reform called the TCJA, um, uh, that had a global minimum tax for low tax intangible income.
Okay.
And so now the Biden administration needs a lot of money because the US has sustained continuing large deficits. And now the Biden administration wants to pay for a, $4 or $6 trillion infrastructure uh, initiative,
Right.
not to mention for the jobs program that it just passed
Right.
uh, before. And so the Biden administration is saying, okay, by making the US corporations pay a minimum global tax, we can also support this idea, this initiative of the OECD. And so, yeah, the Biden domestic proposal also has a global minimum tax on book profits of corporations. Now, the problem, of course, is that the Biden administration doesn't have much of a majority in the House, and the Senate is evenly divided. Only the vice president can break the tie.
Right.
And of course, the Republicans are saying, no, 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 we don't accept any new taxes. So, it remains to be seen um, whether the Republicans are going to allow the US to implement even the OECD global minimum tax, assuming that one is agreed to,
Yeah.
later on this year, let alone the Biden domestic proposal. So you can see it's very complicated, politically, both internationally and domestically.
Yeah. Very much. I mean, could we end up in a situation where the deal is accepted internationally and then the US is unable to get this deal? Well, first of all, would the deal have to go before the House? I mean, before the Congress, do you know? Or
Yes, yes, Congress would
yeah,
have to approve, and that's just what's happened on exchange of information.
yeah,
You may recall the US in 2010, under the Hires Act, said there are too many Americans with assets in foreign banks in places like Switzerland and elsewhere that aren't reporting and paying taxes on it. They're cheating. And
right,
so the US Congress passed FATCA,
right.
Foreign Account Tax Compliance Act,
Mhm.
which forced all the banks around the world to search their accounts for any US taxpayers and to report that information to the US government. And if they didn't, they would be penalized because the US would then impose a withholding tax.
Mhm.
So at first, the world said, no, 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 we can't do this. It violates our fundamental law on bank confidentiality. So the US said, okay, to get around that problem, we will enter into agreements on exchanging information. But in those agreements, the US said, sorry, we can't completely reciprocate right now because our law doesn't allow us to. But we promise to do so very soon. And we will also, because this is a US initiative, and we know the world is working on its own automatic exchange of information, as soon as the world agrees to one, we will also join that. Well, it's now 8 years later, and the US has not reciprocated bilaterally, and the OECD Common Reporting Standard became the world automatic exchange of information standard. And that was in July of 2014. And the US said, oh, sorry, we can't join because we don't have authority, but we'll try to do so. Well, 7 years later, the US still has not joined the Common Reporting Standard. So that's a good example of where the US says, do as we say, but not as we do. Because there's one standard for us, but we're going to hold you to a higher standard.
So in other words, you're saying there could be a situation whereby if let's say this deal on the global corporate minimum tax is accepted, but then not enacted in US law, but the US is able to enforce the imposition of a minimum tax on US corporations, but not necessarily reciprocate with respect to other corporations. Is that
Exactly.
okay?
Yep. I mean, the US, doesn't have, I mean, the US tax rate for corporations right now is 21%. So, the US would say we are reciprocating because I mean, the US would say we're reciprocating with
Oh,
part
because
of it.
it's higher. Okay.
Yeah. But
Okay.
but it would be a double standard, and that's not unusual for the US.
Right. Right. Well, I promised I wouldn't take up too much of your time or too much more of your time. One last question. If you were advising a Caribbean or another small country, any initial thoughts about what you might suggest that how they approach this issue?
Sure, I would send a letter to the Treasury and I would say, look, back in 2012 or 2013, whenever it was, we concluded this agreement on exchange of information under FATCA, and you said you couldn't quite reciprocate, but you would endeavor to do so. And you also said you would endeavor to join the world standard. And here it is now, 7 or 8 years later, you still haven't done either thing. So could you please tell us when you're going to do it? And we will determine whether we'll continue to comply or we'll take other steps according to your response.
Hmm.
So I would try to put some pressure on the US to live up to its bargain. And I would also remind the US that back in 1984, in exchange for exchange of information, the US gave carrots: eligibility for 936 funding, eligibility to host foreign sales corporations. So, and the US has withdrawn those carrots, and now they only have sticks, and yet they don't even reciprocate themselves. So I would try to also obtain some more incentives from the US in exchange for all of the exchange of information help that these small countries have been, giving the US over these years.
Hmm. Sounds as if they need to be contacting you, Bruce.
I mean, it's a complicated situation,
Yes.
and and I don't think it's going to get any simpler as time goes on.
Well, thank you very much, though, for taking some minutes of your time to at least simplify our understanding of this very, very complex issue. Again, Bruce Zagaris is a partner at the DC law firm of Berliner Corcoran Rowe, and he is an international tax specialist, among other things. So thank you very much, Bruce, for your time this afternoon.
You're very welcome.